So tax burden and tax drag is, I would say, one of the biggest threats to your wealth. It's the erosion of your wealth. I look at taxes as a government-imposed bear market. And the reason why I say this is a number of taxes that you need to be aware of. You might be exposed to one of them, all of them, or none of them, but you do need to be aware that the tax drag is real. So if the reason why I call it a government-imposed bear market, a bear market is when the broad equity market drops by 20% or more, okay? Now, when you pay taxes, let's say you pay capital gains taxes, at the federal level, it's generally about 20%, sometimes a little bit more. And at the state level, depending upon what state you're in, that can add another 5 to 9%. So that's almost a third of the gain, right, is in tax. But the reason why I call it a government-imposed bear market is that's called between 20 to 30%. If the market went down 20 to 30% and you hung around long enough, it generally comes back. But once you write the check to the IRS, that's it. It's over. And you're just left with whatever the remainder is. And that's how most people operate. And it's interesting. I did I'm writing this book now, and we did a study going back, I think the last 48 years of data, going back to the end of 1976. And we looked at a index fund. If you were to invest, say, $100,000 in an S&P 500 index fund, and you just compounded it over the next 4 or 5 decades, what would it look like? And the reason we use this as an example, and this is just a hypothetical example, is that the S&P 500 is rather tax efficient. The reason it's tax efficient, it's 500 different companies. On average, about, I think it's 20 or 22 companies change over per year, meaning if there's 500 companies, say 20 of them are removed from the S&P and 20 new ones are added on an annual basis. Some years it's a little bit more, some years it's a little bit less, but that's generally the average. Now what's interesting, that's when there would potentially be a capital gain exposure, right? Because if the 20 stocks are being removed had an embedded gain, that would incur a gain, right? And the new stocks would come in. Also, many of the companies in the S&P 500 pay a dividend. And if you're receiving dividends, that could be taxed as well from ordinary income or qualified dividend rates. And that adds to the tax burden. And what we found was quite staggering. The compounded 100,000 over almost 5 decades grew before taxes to about $19 million. Let that sink in. That's next level, like 100,000 to $19 million. Now that's the average return was somewhere a little bit over 11% with a lot of volatility along the way. There was a lot that happened in those 5 decades. Now, when we factored in taxes on capital gains, ordinary income taxes, and I believe we used a higher tax burden if you were in a high tax state like New York or California, it basically eroded more than half of the wealth. So the 19 million dropped to about 9 and change. And on the surface, that's still pretty good, 100,000 to 9 million. Nobody's really crying about that. But the reality is this, if you had $19 million in your account and a year later it was worth 9, you'd probably be upset. And the difference is this, it happens slowly. Because every year what happens, you get your 1099, you pay whatever taxes are on the 1099, and it's like a slow death. You don't even see it happening because you're getting your, like, all right, I made money, it's okay. And the reality is that compounding effect of maybe losing about 1.5% of growth because of taxes doesn't feel like much on a year-to-year basis, but when you compound that out over long periods of time, it adds up to a tremendous amount of wealth. I think Warren Buffett said it best, the eighth wonder of the world is compound interest. Right, and the investor that understands this really can benefit from it, and the one that doesn't understand it pays it. So that's a big deal. That's a big tax drag. And if you're just investing in that's a tax efficient strategy, and you're not paying attention to mitigating the taxes on a year-to-year basis, you could be leaving so much wealth on the table and not even know about it. So there are a lot of advanced strategies that you can consider looking at to mitigate the tax drag. In some cases, eliminate it, but at least you're being cognizant of that. You with me on that?